Welcome back to the show. Let's talk to Connor Campbell. He's a financial analyst at Spreadex. Morning to you, Connor.
Morning.
Let's talk about three stocks that are reporting this week. First one, Dunelm Group, the mnemonic on that, DNLM, down 11% in 2017. What are your thoughts?
Yeah, no, the chart itself doesn't look too bad in the last month or so. You sort of see, as you can see, it had a really, really sharp rise in September. But overall in the year, it's struggled really. In January, it saw a huge fall, and since then it hasn't majorly been able to recover. Basically, it seemed like repeated like-for-like sales drops each quarterly update. Basically, it had the shock departure of its CEO at the end of August, I think due to sort of personality clashes with the board. You know, it's a retail sector stock in the UK. Like it puts it in a sort of a fairly precarious position.
Yeah.
However, in September, you can sort of see September 13th, its full year figures, really, really sharp rise. I think it rose 9% on the day and then has continued to rise since then. Like the figures themselves, it was still a fairly bad full year report. I think full year pre-tax profit was down 28%, I think, to 109 million. That's because it was still feeling the impact of its sort of World Stores acquisition and the various costs and the losses it took on after that. Like-for-like sales for the year were down 2.4%. Not great figures at all. However, total sales were up 8.5% for the year. I think again due to the new stores it's acquired in the World Stores acquisition, and it reassured investors a sufficient degree. Basically, interestingly, it stated that it wasn't in the DFS realm of big ticket items, which I guess it's sort of a home furnishings company. DFS has obviously done very, very, very poorly. Yep. It is the kind of big ticket item that any kind of shrinking in household spending, people are going to move away from those kinds of items. Dunelm said though, I think its average purchase is in the realm of £35, so very, very different from someone buying a £600 sofa.
Which is always half price. Listen to that.
It also said that it had seen the first 2 months of its new financial year, it started positively, and that again I think that is what's helped it sort of September, start of October boost. Now obviously it's got to deliver on that promise of it starting positively, and investors will see just how positive that positive start was. I think any reduction in its sort of like-for-like sales decline, the last few quarters have seen 2%, 2.5% drop year on year. If you can even just get that under 2%, I think investors might be happy. Also, some kind of update on its CEO search. Obviously, it's only a month and a half maybe since the CEO left, so it's still early in the running for them to find a new replacement. But I think investors, just a reassurance that they are looking for someone, and perhaps an update on when they can expect that appointment to be made. Our clients, however, they're selling around the 715 mark just because it's climbed so sharply, and it is in a sector that it wouldn't be a surprise if it did post another 2.4%, 2.5% like-for-like sales decline. So our clients are selling around that 715 mark.
Understood. Let's have a quick look at WH Smith's. They're up 30% this year, a firm favourite at the airports. So common sense would dictate that a company that is, I think it's 225th year anniversary this year. It's a company that in the last few years is sort of directly in the line of the Amazon juggernaut, and arguably could have been just completely wiped out by Amazon. Taking all of that, book buying realm away from it. However, it's that when it hit £21 like last week, that's an all-time high. It's ridiculous, sure, really. But it's because it's moved. It knows what its strengths are, and it's increasingly moving into that travel sector. Consistently, that travel division is posting 5% like-for-like sales growth year on year. Obviously, it's got issues in the high street. I think half-year high street like-for-like sales were down 3%. Recently, its third quarter like-for-likes were down 4%, so that it is a concern that decline in the high street might be accelerating. However, it is taking steps to mitigate those losses. It's opening more and more post offices in its stores, giving people another reason to go in. Obviously, if you go into WH Smith's nowadays, it's barely a bookstore. It's mainly stationery. It's sort of like a corner shop, really. It sells everything, and like the books are sort of shoved in the back. And the shelves are at 12 foot high now as well. So
exactly.
Double the sales. In terms of clients, what are they up to?
They're buying around the 250 mark. Obviously, it's climbed incredibly rapidly, even since mid-July. So there is plenty of room for a decline. However, the travel division figures have not failed to impress for a while now. It recently opened 3 stores in Italian airports, so it's got the whole of Europe to expand into. If it can keep pushing, I think at the moment the travel sector comprises around 47% of its revenue. If it can get that to 50% and beyond, then it's in a really good position to sort of weather any high street wobbles. Really, I think pre-tax profit is expected to be up around 6% for the year. I think between 138 and 140 million.
it's going to post some decent figures, I think, on Thursday, and our clients are buying due to that.
Understood. And let's wrap up with N Brown, mnemonic BWNG, up 61% this year.
Yeah, part of this has to be put in the context of it before 2017, it's had a few really, really ugly years, and I think at one point last year it was trading around 170 or something. But still, 60% growth regardless of where you were beforehand is still very impressive. That puts it closer to things like ASOS and Boohoo than it does sort of Next and M&S and its sort of high street counterparts. M Brown mainly comprises of JD Williams, Giacomo, Simply Be, sort of specialty clothing lines, for bigger people, I guess. Its figures, interestingly, it sort of hasn't been that great, really. There's been a few ugly issues. Pre-tax profits back in April fell 20% because it had to put aside 25 million for PPI compensations, which sounds odd, but I think it's because it offers like credit services for its customers and things like that. In July, it had to put aside another 40 million for sort of credit insurance issues it had found between products it was selling between 2006 and 2014. However, it is set on the sales side of things. I think online sales have consistently been posting double-digit growth. Back in April, that pre-tax profit decline was more than overshadowed by the fact it announced it was selling its products on Tesco's website, that's a pretty huge tie-up for any company, really, especially a clothing company that is looking to push further and further online. I think back in June, it said it was closing up to 5 high street stores, which is, again, a good sign for investors that it's taking its online section seriously. I think online now comprises around 70% of its sales. It's done a very good job of moving away from catalogues and into sort of almost purely online offering, basically. Half-year figures, I think it basically needs to keep up that sort of double-digit online growth, and it will depend on what the pre-tax profit figures look like once those sort of various financial fines, the money is set aside for those, have been stripped out, basically. If it can eke out some kind of pre-tax profit growth once those, the 65 million it's had to be put aside, is stripped out, then I think investors might be willing to keep it around that 350 mark. Our clients, however, again, a bit like Dunelm, it's climbed quite rapidly in a sector that there is room for perhaps a bit of wobble in the second half of the year if household spending continues to shrink, so they're selling around the 350 mark.
Connor, as always, thank you very much for your time.